If you actually look at where break-evens are trading, in the US, we're sort of 235 to 250. We've been at points over the course of the summer. The UK, we've got a 3 handle, approaching 4. So you could argue the break-even market saying, yes, there's some inflation coming, but it's those really, really low real yields, deeply negative real yields, where the bond market's probably just challenging exactly what's going on. And it does feel a little bit of a disconnect, because I would agree that, yes, we know it's going to be transitory. We know there's been sort of used car prices that have picked up inflation numbers in the US, and they have to come back down at some point. But when you look at things like wages, when you look at the shelter component and some of the high-frequency shelter data in the US, it looks like it might be a little bit more sticky than maybe Jerome Powell and some of the Fed members think.
So how long until we know that? Because there are some stickier stuff as well. I mean, even in commodities, which I know economists wind up looking through, but a lot of the changes that we're seeing, say, in the power market, they're structural. This is a structural shift. It's not necessarily just a short-term supply issue.
So I think the most important thing that the central bankers, whether it's the Fed, whether it's the Bank of England, will be looking at is the wage data and how wages pick up. And we need to get over the period of the employment protection plan. We need to get over the furlough scheme here in the UK, and then give it another couple of months, probably a little bit sooner for the US, maybe towards the end of the year, beginning of next year for the UK, and see what these numbers are looking at. How healthy is the jobs market? And are we seeing still this lack of supply of labour and a big demand for it, which is offsetting that? And I think that's when the central bankers will start to get a better picture as to what exactly is going on, and maybe they need to react a little bit quicker than they're currently predicting. But for the time being, they're probably happy just to stay the course and wait.
I want to go back to a conversation that happened a little earlier on Bloomberg Television between Tom Keene and Ray Dalio. And Ray Dalio was making the point that each economic cycle we go through, interest rates peak at a lower level. And that's been something that we've gone kind of from Volcker all the way down. Basically, that's what's happened every economic cycle. And the QE, every time we've used it, has got bigger and bigger. Are we at a point where that is going to stop, i.e. the inflationary debate we've just been having will actually cause peak rates to be a little higher this time round, and as a result of which, when we come to use QE again, which we inevitably will, actually the size and scale of it will be smaller? I'm wondering whether or not we're reaching the bottom in monetary policy in terms of where rates are going to end up, and actually this time round, because of the inflation that potentially could be stickier than we've seen really for quite some time, actually the rate cycle may be a little bit higher. Where do you think peak rates, for instance, in the UK will be this time?
So I think the difficulty we've got here is the debt burden. So we've issued a whole load of debt. And when you think about it from a central banker's standpoint, you do not want rates to be particularly high, because you've got to fund that debt and you've got to continue servicing it. So you do get this sort of financial repression which keeps rates low. So although we've had this huge QE program which pushed it down, and we are going to step away, I think it's going to be a long...
So we could end up with inflation quite high, but rates quite low because of the debt burden. And so basically that's stealing from investors.
And if you look at what the bond market's pricing at the moment, as I said earlier, that's exactly what the bond market's saying. We've got those break-even levels, yet we've got those deeply negative real yields at the moment. So the bond market is saying rates need to stay low because you need to finance this debt, but it's also saying actually there is going to be a little bit of inflation out there. So the deep negative real yields is probably what gets us out of this big debt burden that we've built up over the last year, or really started since the financial crisis, but has been exacerbated by the pandemic.
So is this a stagflation view that we're going to be taking in the medium term?
I don't think it's necessarily a stagflation view, because I think you're going to get reasonable growth at the same time as you get the slightly higher inflation that we've had over the last decade or so. I just think central bankers are going to be prepared to allow that inflation backdrop to be a little bit higher than maybe we would have thought previously. They seem to, at least governments seem to have become less concerned about deficits and debt burdens, and are happy to try to grow our way out of it. So I think austerity is behind us from what we knew in the financial crisis. We're going to have the support of governments, the support of central banks, and it's going to be a combination of low yields but with growth that's going to get us out of this.
German election this weekend, what's priced?
I think it's pretty much an SPD coalition with probably the Greens and the FDP, get my acronyms right. I think the market has got that in the price to some extent. So actually, interesting enough, in the last couple of weeks, some of this sell-off that we have seen in bond yields has been led by Europe. But what's going on in Germany, what's going on in the UK. Possibly once we actually get the final final formation of it. Maybe there's a little bit more weakness left in the German market, but I think a lot of it has already been priced.
Is there an implication from the gas crisis that we're seeing in the UK right now, in Europe right now, for the bond market? And if so, what is it?
So in the UK, we've obviously got kind of the stabilisers from a consumer standpoint, so it's not going to be as dramatic. I think we've heard this morning that some of the smaller companies that might be challenged, shall we say, will get some form of support. I think this is the wrong type of inflation. Bear in mind, this is a tax on the consumer, and I think again the central bankers.
It's a drag on growth. Is
that could well be a drag on growth. So again, I think the central bankers will want to effectively look through that. They're not going to be raising rates in anticipation of higher energy prices. That's not what they want. They want it based on things like wages. That's what they really want to see.
So not a 2008 scenario. Hey, Ian, before we let you go, the UK issued some green bonds. I mean, insanely oversubscribed. What do you make of how this market develops? Like, are they good investments? You're going to pay a premium, a greenium, as people are calling it. What do you think?
There's just been a huge demand for all sorts of green bonds over the course of this year. We've seen that even though that a lot of them have come with greeniums, they've still done very well on the break. We've seen huge demand for them. I think we have 90 billion sterling, a record demand for the green bonds today. We're going to see another green bond from the UK later this year in a 30-year part of the curve. I wouldn't be surprised if there's record demand for that as well, and probably allowing them to maybe do more than the 15 billion that they set out to do earlier this year.